Good morning. I'm John Kosar, Chief Market Strategist at Asbury Research. Thanks for viewing our latest Following the Money podcast. Today's date is Sunday, July 14th, 2024. Today I'll be talking about what Asbury Research's latest data-driven market research and our own quantitative models are saying about current financial market conditions. That is when to be on offense and looking for opportunities, which we have been doing since November of last year, and also want to be playing defense and protecting your capital, which I think we're going to be doing here very soon, as the market is historically very overextended and, as such, particularly vulnerable to what could be a really nasty corrective decline. Asbury Research has been providing both investment research and money management to individual and professional investors since 2005. To get more information about us, visit asburyresearch.com, and you can use the contact tab right here or just click the link in the description of this video. Finally, if these YouTube videos are useful to you, please like and subscribe. Let's begin with just a couple of very brief announcements. First, I'd like to congratulate my son Jack, who works with me at Asbury Research, for passing level 1 of the Chartered Market Technician's exam. I received my CMT designation way back in 1999. Next, I'd like to thank the thousands of investors that attended my July 10th educational webinar for Fidelity Investments entitled Asbury Research's Mid-Year Investment Outlook. This is my 10th year providing educational webinars for Fidelity. You can view the video of this presentation via the Asbury Research YouTube channel. Finally, my next live interview is going to be this upcoming Wednesday, July 17th on the Schwab Network at approximately 9:15 a.m. Chicago time. Now let's follow the money by identifying our key areas of our focus as we start to look deeper into the summer months. First of all, the market remains exceptionally narrow. Of the 81 ETFs that we track, which encompasses sectors, industry groups, and also commodities, just 8 of them are outperforming the benchmark S&P on a strategic quarterly basis. These outperformers include the consumer discretionary and technology sectors, semiconductors, regional banks, biotech, telecom, and precious metals and mining. Asbury Research currently has open long ideas, and many of these ideas, subscribers can get a lot more detail on these and how to participate in them by visiting the Research Center, which is right up here on your screen. Next, let's take a look at the latest signals in our Asbury Research models. The first one we're going to look at is the CPM, or the Correction Protection Model. So let's get over to the Research Center and let's take a look at CPM. So we've got CPM right here. CPM is I think it's the first model that we ever built here at Asbury over 10 years ago. It was built as kind of the result of getting asked by a lot of our money manager clients to build them a simple model that was risk on or risk off, wasn't overly complicated. It didn't really move a lot, but it would keep their clients from going through a horrific experience like they did with the financial crisis. And then the second part of that experience was, after many of these investors got out near the lows, the market turned around pretty abruptly, started moving higher, and they didn't have the guts to get back in. So that's what CPM does. It's really an on and off switch, and it's based on our own indicators and market internals, which measure the health of the market internally, rather than trying to chase the tail of the S&P 500, which, as we all know, is extremely volatile these days. So currently, the CPM model is risk on as of May the 3rd. And if we scroll down, we can see we've been effectively risk on since November the 2nd. We had a little 2-week or so stretch here where CPM, it went to risk off in the middle of April. It went back to risk on May the 3rd, and we've been there since. So despite the market's overextended condition, we are still risk on in our model, and we've captured essentially all of this move since the bottom that we made at the end of October in the S&P 500. The next one we're going to look at is the Asbury 6. The Asbury 6 is probably more well known to those that aren't Asbury Research subscribers or money management clients because it's typically what we talk about if we get a chance to speak to the press. The Asbury 6 is a metric that we built over 5 years ago simply to keep us on track with the market. It's very difficult. It's very easy to get faked out of a position these days, right? Because I mean, there was one day last week where the S&P was up 50 in the early morning and it was down 50 by lunchtime. Very easy to get faked out of a good trade because of the volatility that we're seeing day to day. So what we did is we back tested all of my favorite tactical tools that I've been using for my 40 plus years in the markets. We started to test them kind of as a team um, to focus on what the internals of the market are rather than, again, trying to chase the tail of the S&P 500 and get forced out of good ideas. We found 6 indicators that work very well as a team. And by that, I mean when 1 or 2 indicators are giving you a false indication of what the health of the market is, the other 4 would pick it up. So right now, all of the Asbury 6, which is the rate of change in the S&P, relative performance between stocks and high yield bonds, investor asset flows, volatility, trading volume, and market breadth are all green. They're all positive. What does that mean? It means for the time being, the internal health is healthy. The internal health of the market is in good shape as we head into next week. Now let's look at sector rotation. Sector rotation has been difficult this year. Year to date, only technology, which is XLK, and communication services, which is XLC, have outperformed the S&P 500 this year, and only by 3.7 and 1.1% respectively between XLK and XLC. Again, this is made trying to outperform the market via sector rotation very difficult. The CEF model is our own model that measures the velocity of money that's moving around the 11 sector spiders. And the current signals here, you can see the top signals right now. Again, this is based on the velocity of money that are moving around those 11 sector spiders, which together are the S&P 500. And we've developed a scoring system for that. So the top sectors right now are financials, utilities, and technology. The CEF model has favored technology, or XLK, as of May the 20th. Since then, XLK has risen by 9.1% outright, and it's outperformed the S&P by 3.3%, which is effectively what it's outperformed all year. As I had mentioned, it's only outperformed year to date by 3.7 in terms of XLK. You can get more information about all of our models, including the back-tested performance charts and more data by visiting asburyresearch.com, clicking models here up at the top of the screen, and then scrolling down to the model that you're interested in. The next thing I wanted to show you today was we're going to change our view here, and we're going to look at a part of the CEF model. We call them rainbow charts, and we make these for all of the 11 sector spiders so we can look back for 1 year and see what the scoring, the CEF's ranking score is historically looking back a year. So up in the top here, we have XLK ranking scores for technology, and anything green is favored. If it's up here in green, it's favored. If it's down here in the yellow, it's neutral. And if it's down here in red, it's a void. So basically, since May the 15th, with the exception of a day or two here in early June, tech has been favored according to the CEF model. Since then, it's outperformed by about 5%. Again, there's been ebbs and flows there, but this kind of shows you the relationship between the asset flows as detected and scored according to our CEF model and what that means according to the relative performance. Down here, we've got the corresponding relative performance chart of XLK versus SPY. The next thing we want to talk about is, let's just get back here to the Asbury Research website for now. The next thing we want to talk about is domestic asset allocation. That is done with our tracked via the Carp model. The Carp model is part of our where to be invested page, where we have the Carp model. We also have US versus the world, which I'm going to get to in just a moment. Carp has had us overweight large cap and growth basically since the last week of May. They're both outperforming right now. There are some signs of a change here that there's more information on, again, if you visit the research center. But again, in that space where the performance has been, at least for the past couple of months, has been in large cap and also growth. Uh, Individually, in our previous Follow the Money podcast, which was 2 weeks ago on June the 30th, we said that Microsoft's June 11 breakout higher had targeted an additional 7% rise to $473 a share. The target was essentially met on July the 5th, a little bit more than a week ago, and Microsoft has corrected lower by about 4% since then. The linear correlation between Microsoft and the S&P 500 has been tight and stable throughout the past 35 years. So as goes Microsoft from here, we think that could be a very good indication of what to expect from the overall U.S. broad market here as we look towards the end of the summer. Um, we discussed this in a lot more detail in today's weekly wrap up, which is our Sunday report, which gets you prepared for the opening on Monday. That report, again, is available on the Research Center to subscribers. Global asset allocation, which again is right next to the Carp model here, we have noticed that Taiwan, actually, let's get in there and take a look real quick. So here's the US versus the world model, which tracks the relative strength of the S&P 500, the US broad market versus 25 foreign markets. You can see that Taiwan and South Korea are both showing up on the model in multiple time frames. Taiwan has outperformed the S&P 500 by 8% since April the 29th. Both South Korea and Taiwan both have to do with these countries' involvement with artificial intelligence, with AI. So it's very specific to AI and not really specific to any particular geographic region around the world, but that's what's going on in that space. Finally, looking at the economic calendar for next week, we have June U.S. retail sales and industrial production on Tuesday, and June housing starts on Wednesday in what's going to be a relatively light week on the calendar, but there is some Fed speak in there. There's several Fed governors that are going to be speaking throughout the week, so something else to keep an eye on. So there you go. That wraps up Asbury Research's Following the Money podcast for this week. Our next Following the Money is tentatively scheduled for Sunday, July the 28th. If you like our approach to investing, we can help you with either data-driven research or money management that implements my 40-plus years of experience in the business and our own quantitative models here at Asbury Research. You can request more information again by going to the Contact tab here and telling us what you're interested in. Hope to see you here again in about 2 weeks. Please don't forget to like and subscribe. Have a great Sunday.